All right, it's officially 4:15. That's what we're about. Can everybody hear okay? Yes. All right. Welcome. For those of you that don't know me, I'm Kathy McKay. I'm the Director of Employee Services, and I oversee the Des Moines Teachers Retirement System. This is our annual meeting. Thanks for coming out tonight. It's a beautiful night, so we will try to be able to get you home to see the Northern Lights tonight. Our agenda today is pretty short. We have individuals here from BTC, and Ben is here from the Des Moines Business and Finance Department, and they will go over some of the financials. We'll go through those. If at any point you have questions, please ask. This meeting is for you. This is for you to get questions answered. No question is a dumb question, and chances are if you're thinking of something, so is somebody else. So please use this time to get those questions answered. We're going to go through that. And then we have the election for the Des Moines Teachers Retirement System Advisory Committee. So as soon as they do their presentation, then we'll proceed with that. With that, I'm going to turn it over, and here they are.
Good afternoon, everybody. Can you hear me? Hopefully. Again, welcome. Got a brief presentation here before I turn it over to our friends at Bankers Trust Capital Management. Welcome, introductions. Ben Luckman, County Manager at Des Moines Public Schools. We have Jeff and John with the Bankers Trust Capital Management. There's your advisory committee for the Des Moines Teachers Retirement System. I know there's some of them here. I've seen Brad and Blake. I'm sure there's some others. Lola and Barbara here. All right.
Christmas over here.
Again, welcome. This is for Des Moines Teacher Retirement System. Financial summary for the fiscal year ending June 30th, 2025. First, we have a participant comparison. You'll see the change there from fiscal year end June 30th, 2024 to June 30th, 2025. Active members, this is a closed plan. There are no new active members joining this plan. So you'll continue to see that number go down, and well as the total members going down. Does anybody have any questions on this? Next, we have a brief summary of the change in the fund's net position between 2024, 2025. See the interest and dividends, less investment expense, contributions, realized gain, unrealized gain, and then all the deductions, the benefit payments, and a couple other miscellaneous expenses that come out of the fund. You see the big difference there. Change in that plan, net position for fiscal year looked much better than the previous year. Previous year was driven by very large deductions for one-time lump sum payments coming out prior year. Yes.
What's the best way for them to access that? If you go to Des Moines schools, and then get to it from a lodging.
Yes, eventually it'll be where board, like the board information is, but here's what the website looks like. And so from here, you'll just go to meetings. And then you will click on your meeting, which is this one. And there's our
brand new system. What is the website?
It's Simbly, SIMBLI I'll add it to the DMTRS committee YouTube page so that you can also just click there. Currently it has the outdated link.
Everybody have access to that?
Yes, it's a public site. The DMTRS, that's where all of the committee meetings are recorded and stored. So this one will be recorded and stored there as well.
Okay. So there we go. Oops, we'll come back, I promise, there, maybe. A little financial comparison there for your information between FY 2024, FY 2025. You can see the net investment income was very stable, just change of a little over about $200,000 between the years. Contributions decreased just about 100,000. Again, you're gonna continue to see that to decrease with you being a closed plan and active members going to inactive and then retiring. Benefit payments, you can change, that change I mentioned briefly, fiscal year 2024, so our large lump sum payouts. Didn't have really that many lump sum payouts in the current fiscal year. And your investment rate of return, you see really doing very well. Land assets had a little over 175 million at June 30th. Decrease of about 1.5 million from the previous fiscal year. Funding ratio, 91% compared to 86% in the prior year. You can see that compares very favorably right there with Vipers. Vipers is a year behind on posting their information. We do not have the fiscal year 2025 information for Vipers, but very close in the same ballpark as Vipers, 91% to 90.7%. Now moving forward, DMPS continue to work with all plan stakeholders and consideration of all practical opportunities to improve the plan. So let your thoughts and concerns be known. Before I leave, turn this over to Jeff. Any questions? On the annual report for the fund, I'm not, Kathy, is that on the website?
I can post it back again on this new platform. So if you access the Des Moines Schools webpage and click on board, then through that you can access this new symbol platform that we'll be using. I'll make sure that we post out the annual report again. It also went to the board, so it should be out on old board documents. But I'll post that out there, and that does break down things by.
Yes, there is this is just a summary from we've taken from the annual report. The annual report has greater detail. It does show the breakout you mentioned between the age groups.
What month was it?
October just went last month.
If somebody wants a specific copy, just shoot me an email and I can email you a copy if it's easier for you as well.
Thank you. I'm Jeff Birdsley from BTC Capital, and I'm going to turn it over to my boss, John Augustin.
Talk about passing the buck. Yeah. Yes, as Jeff said, I'm John Augustine. I'm the Chief Investment Officer at BTC Capital Management. And as Jeff said, he's the head of our fixed income team, which we're glad to have him here today because, as you know, the largest single asset class represented in your plan is fixed income. So Jeff will be here to discuss that a little bit, answer any questions you might have on that portion of the portfolio. But just taking a quick look at the information we provided, we'll We'll be brief, be respectful of your time. So if we could go to the next slide, just to kind of touch on some highlights, just as a reminder. There is a document in place called the Investment Policy Statement for the plan, and that provides the parameters that we utilize in managing the assets. So those are kind of our guardrails in terms of what's allowed for us to do in regard to the management of the plan assets. And it's the school board that oversees the guidelines and approves of any changes to those guidelines that may be recommended from time to time. The portfolio value as of September 30th, 173.4 million. 73% of that is in fixed income or bonds and money market. And Jeff oversees that segment of the portfolio. The remaining 27% are invested in a variety of different types of stocks. We incorporate several different, as we call them, strategies into the portfolio, including large cap core domestic stocks, companies based here in the US. We also have a significant amount of the plan invested in what we call our value strategy, which emphasizes, once again, domestic stocks, but those that pay above average dividend yields to generate more cash flow in the plan. Then we also have some exposure to small cap stocks, and then also real estate. We have some significant holdings in some real estate investment trusts, once again, primarily to help augment the income because those are higher dividend paying securities. So that's kind of the overview, and I'll turn this over to Jeff to talk about the specifics in terms of the fixed income holdings.
Thank you. The fixed income holdings, again, they represent about 73%. And the purpose of the fixed income, obviously, is a couple of things. It provides stability of future cash flows for those future payouts, as well as a nice stable income flow from year to year. So that is one of the, it's a great aspect of the portfolio. As you can see, the funding ratio, they're at 91%. That's a tremendous ratio for a public plan by any means. And a fixed income is a good part of that. It's a stable portion of it. We focus on long-term investing. The average credit quality of this portfolio is very high. I think it's A3. We do have a little bit more weighting to corporate bonds. That's how we generate that additional income. The performance of the account on a relative basis to its benchmark has been outperformance very consistently for quite a long time. Again, high quality, A1, average maturity 8.5 years. That means, most of the cash will come back within the next 16 years. So you can see it's built around the distributions that are going to happen that you normally would have in a closed fund that we have today. And again, a current yield 4.9%. That's a great yield in an environment where currently we're reinvesting right around that level. So we're able to keep that income flow coming back into the fund. So that's kind of where we're investing at as well right now. So are there any questions? So this is good because that means we answered every one of your questions, right? If you have any Iowa Hawkeye trivia questions, I'm going to turn that back over to John. Thank you.
I do have a question, sorry. If the interest rate and the rate of return we're getting stays up, why did our excess dividends go down?
So your dividend, excess earnings dividend is really part of the two different items make that up. One, excess earnings, your numerator, and your denominator, your annual annuities. So in different groups, it's also broken out by groups. So you got A, B, C, D, and E. That depends on individual enrolled in the plan when they retired. The largest group is Group E. I think that part of the plan started on July 1st, 2003. They had the most members. Group A is done, Group B is done, Group C is close to being done. It's just gonna be groups D and E. So annual annuities go up because of why? You have more retired members. When that denominator increases, what happens? It gets smaller. So, you get maybe, a little bit more of the money. However, you're gonna continue to see that little pool get smaller and smaller because you're gonna have more members. And that's just the nature of having a closed plan. The people that left to retire are basically, they're all Group E. So it's gonna change, it's gonna fluctuate a little bit. The last piece, I did look at that, and this is the smaller piece, is just also due to rounding. We round everything up or down on that, payout for, to make it, easier to process payments and everything. And, Group E, the prior year, they're sitting at, we said 13%. If you calculated it out two places, it was actually 12.52%. Got rounded up to 13. This year, because of the change in annuity payments, Group E had an increase of almost $700,000 in annuity payments, which affects your denominator. Everybody knows 4/5 is greater than 4/6. Well, the change was about 0.25% and went down to 12.27%. It triggered the rounding from 13 down to 12%. Seems kind of, I know that's a convoluted answer, but you're just gonna get that same effect year after year. As more people retire, you get more of the pie, but there's more people that's gonna take a piece of that pie. Does that make sense? Unknown on that. I mean, because there are two pieces, the numerator excess earnings, probably gonna stay pretty steady, but there's no guarantee that anything on financial markets. I mean, they're the gurus for financial markets. If it goes low enough, Group E's trigger point is 4.5%. If we start returning less than 4.5%, there's no excess earnings to distribute. So, keep your fingers crossed that doesn't happen.
That's
What's the average of excess earnings people get?
it's per group.
So the average really is by group. Again, whether B, C, D, E, and
6 and 8.
between 6 and 8% for every group.
So it's by group. I think it's, don't put me off of these, but I think it's 8 for group C, 6% for group D, and 12% for group E.
What you are getting.
And it's percent of your monthly pension benefit. So everybody's differs because it's based on what your pension benefit was.
So I retired after about 40 years. That's gonna be a lot different than someone who retired after 30 years or 20 years, they're just, your numbers are different. And so that percentage is going to come off what you, your 15, 30 years. If that makes any sense at all. It's just what the amount of years you put in, your salary, basically, I think.
Did that answer your question?
Kind of, yes.
So it's like tens of dollars, not thousands of dollars.
It's usually around the hundreds of dollars range, like, I don't know, ranges for most people between 100 and, 250-ish. Depending upon what group you were in. But again, it's whatever your monthly benefit is. And for group E, it's times 13 or times 12% for this year. If you were in a different group, then it could be a different dollar amount. And if you want to see some illustrations, I'm happy to show, we can show you what it would look like for you more specifically. Brad, did you have anything you wanted to add on the excess earnings?
And it's really complicated. We have a couple of actuaries on the advisory committee, and we've studied this. Lucy, who's on the call today, put together a slide deck to kind of try to illustrate different scenarios to kind of say if the market return is 6%, what does that mean for each of the different groups? If it's 8%, what does that mean for the different groups? Looking at the results there, it's really complicated. It's a really difficult formula to kind of explain on the fly here. I don't know if we have time after the plan materials are over, we could pull up that deck and I can kind of talk about some of the different dynamics that can impact what different groups get paid. It's not going to be the same from year to year for the dynamics that were being described earlier around like denominator, who's in the pool and everything else. But I can talk a little bit maybe after we have all this plan material done about sort of some different scenarios that could pop up and how that would translate into excess earning returns for the different groups. But no promises that it's going to be simple because this is really complicated stuff. It was not a simply designed plan when this mechanism was set up. So try the best in can with those charts that we have, but we'll see what kind of sessions you have after and walk through that in a couple minutes here maybe.
Thank you, Brad. Any other questions? Address?
Kathy, do you want to give maybe some broad overviews of some of the actions that have occurred relating to the DMTRS? I'm thinking about the retirement incentive that was passed last night, and also where we are with the Gallagher study that we, as an advisory board, approved and the school board ultimately approved. Just kind of this broad topic, so members know some things to be looking forward to.
Yeah, thank you. I was just going to get to that. So last night, our board approved a retirement incentive for active DMTRS participants who have attained age 55 by June 30th of 2026 and will have 20 years or more of service by that same date. Those individuals will be eligible for a $50,000 incentive and then $2,500 per year of service, and that's based on full-time service. Those people who are eligible should have received an email today. They're also rolled out an incentive for IPERS employees. The difference between the IPERS and the DMTRS incentive is the IPERS incentive is a flat $50,000 and there's no additional for each year of service. Those people under Des Moines teachers are getting that additional for each year of service. And that's to take into account any differentials between retirement plans. We know it doesn't make up a full difference. For some people it might, for some people it might not, but it is in recognition that the plans are not identical plans. So that was approved last night. Also, 2 meetings ago, the board approved a study for us to do an asset study regarding our plan, an asset management study, so we can look at, as they addressed earlier, they have an investment strategy that we have given them that they have to work within our parameters. So right now we have a 70-30 investment strategy, which is we have 70% of our plan assets in a fixed asset accounts and 30% can be in equity accounts. We often get asked, or we ask ourselves, what would happen if we went 60-40? What would happen if we went 50-50? What happens if we went all in and went, 70-30? What would that do to the plan? Well, yeah, but we need to study what that would do. We have a higher population of retirees than we do of actives. And so we have some obligations that we need to fulfill to those retirees. We want to make sure that we have money in the plan and that it's stable and we can continue to pay out your benefits. Well, it may sound great. Let's go all in and go 70% in the equities and make big money. We can also lose big money. So we have to be fiscally responsible in those decisions. And we are having an actuarial firm of Gallagher look at what it could do if we tweaked those parameters and how it could impact benefits to people. If there's a sweet spot of where they feel we should be to be fiscally responsible and allow to continue this plan to grow and your assets to grow, but not put the plan at too much risk. So we're embarking on that strategy that study. We just, like I said, got approval 2 board meetings ago. We're still working on the engagement letters and details with Gallagher. We hope to have some information on the results of that study early in 2026. questions on that?
How do inactive members impact the plan?
So inactive members, we have, when I do the reports, everybody always laughs because I say, are you an active or an inactive active? And they're like, what do you mean? We have both groups. So an active participant in the plan is anybody who has money in the plan. And then there's what we term active. To us, that means anybody who's still contributing to the plan. An inactive active is somebody who still has money in the plan, but hasn't taken it out. They're no longer working for us, but they haven't taken it out. How they impact the plan is we still are liable for, are responsible for their benefits within the plan because they're vested in our plan, but they aren't making any contributions to help.
That's because they're no longer employed by the district?
Right. They've left employment and they've chosen not to take their money out. So their money is sitting there continuing to grow, and continuing to be part of our assets.
At what point an inactives roll the money out to their own account?
So typically our inactive actives don't take their money out until they've attained age 55. Because if you take it out prior to 55, you forfeit the district contribution. Most people are not willing to do that. So most of them are keeping their money in, and some people have kept it in far beyond that. And they're just getting the annual interest rate that the plan earns.
And is that a contact you, like to initiate at 55? That's a contact you?
We don't initiate that at 55. We send out statements annually and it has information on it, of what their balance is. And if they want to make that distribution, then they can contact us to make that distribution. Yes.
I have more of a comment than a question. I retired just this last June, got my first pension check in August, and it was $300 less than what the projection said it was going to be. That's a huge concern for me. They are working on it. They've been working on it for now 3 months. I still haven't got an answer to why or what they're going to do. We hope to have a solution for you by the beginning of next month. I wait till the middle of that month. I send them another email. Yes, we think we have something. Oh, we ran into other things. And they were supposed to have something for me by the mid of last week, and I've yet to hear from them. The last I heard, there was something in the software computer program that was off, that they're looking into, that they're trying to figure out why my projection was so far off, because that's a huge deal. I can't go back in time and reconsider my decision to retire. And if it was $300 per month less, I very well might not have done what I might not have retired even. And so it's a great concern. They're working on it, but it's been over 3 months now. And so I just wanted to give all of the actives a heads up that those projections that you're provided by the district may or may not be accurate. So,
I can address some of that. We did notice an anomaly with your projection. I have run samples of the last 4 years of retirees, if they would have retired every single month of the year to see if there was any variance in their projections, and there isn't. For some reason, it was your projection. And I've been in contact with the software company and they have gone through, they've gotten developers, we've gone through all the formulas. They're looking at some extrapolation of some date function that impacted years. They thought they fixed it. They deployed a fix. I ran it again and ran every single month of retiree, looking at you if you would have retired every single month for 2 years. And it still looks weird to me. So there's still something with just yours. I tried to replicate it with, trust me, with hundreds of different things that I've looked at and I cannot figure it out. I've gone back with looking, like I said, of the last several years of retirees and tried to see if there was variance in theirs between month to month, and there's not. And so while I understand it's a huge frustration for you, I am trying more than I can't do much more than what I'm doing. I'm trying to get an answer for you. And right now I don't have a good one. I was hoping that you would come today so I can show you some of the things that I'm seeing in person, so you can see that information.
Was anybody else's off? Because mine was off too. Mine wasn't off that,
No, yours wasn't off that one.
but mine.
Some of it was the way that they run the projections. If we put in June for your retirement date and we run the projection, it doesn't take into account your summer checks. And so then it's off. So we thought this year we would put in August because then it would show all of your income. Well, then it gives you extra interest because it calculated interest for July and August. What we did was not, we learned from that and we won't do that again in our projection. We thought we were making it better and we did not. That's on us.
Is this a new system?
No, it's not a new system. It's the same system we've had since two thousand
It's
and
just a
twelve.
glitch on a few people.
Yeah, and I can't, like I said, I have run. What they're telling me, it's something with the retirement month and the birth month, some combination of it was causing an issue. So I tried to find people that had the same retirement month, birth month thing, couldn't find anything there. Then I took everybody and ran them for an entire year. So I looked, if you retired January 1, February 1, March 1, to see how much variance there was. Everybody's was consistent. Yours like went up, down, up, down. It was crazy. And so I don't know. It is something specific to yours. And we will get it fixed if I have to go sit with a developer or if we have to do some manual calculations with some actuarial support on that. We will get it fixed. And I will have it.
Accounted for my difference then. I mean, wouldn't everybody's be different then?
Everybody's was a little different.
What was the average?
I can't say because it depends upon what your pension dollar amount was. If you want to, I'm happy to talk to you individually about them. We have had, I sent them back. I sent all the projections from the last several years back, had the software company review them. I reviewed them. I'm comfortable in what they're producing, except I'm not comfortable with for some glitch in that one.
Is there something you'd recommend to actives to do in terms of monitoring their reports from year to year to year so that, like, I'm not sure how many actives, even if I got a report, that I have any sense that my report was wrong. So what should an active be doing now to?
So on the report, there is only what you get when you do a projection is you get the projection that shows what your total balance is, district balance and employee contribution. Then it'll show you if you selected the straight life annuity, what your benefit is, partial, full, and then the joint survivor ones. When I looked at the projections for Chris, everything progressed right, except for the joint survivor benefits. It's something within that. So if you are a current person who's getting projections, what I would recommend you do is just look and make sure that your total balances are progressing. That means we have the right total balance. It's something right now with just that one joint survivor calculation. Is that helpful?
Do you use a different system for projections versus when the actual benefits are determined?
It's all the same system. Projections, we're putting in what their income is and projecting out interest rates. For the other, it's just based on what's already in the system. Yeah,
Could people that are nearing retirement see the final calculation when they're evaluating retire, not retire, just to kind of like bridge that gap, maybe like take the projection out of it and say if I retired today, what would I get?
yeah, you could do one if I retired today and take the projection piece out. But it's gonna be short than, 5, 6, however many paychecks.
But absent like a software fix, does that feel like the best step that you could take? To
Yeah.
stop retirees from making decisions that may not pay off long term?
Yeah, we can certainly do that. And we typically, people will ask for a projection like today, what if I do 2 years from now, 4 years from now, and we can give some of that information. And historically, they have proven to be much more accurate than this one that we're experiencing that issue with.
If we ask for like what would be today, then that, the worst case scenario is that it's just a little lower than what it would actually be. Because you wouldn't cover in the rest of the year.
Correct.
Not helpful for like a Blake who's farther away from retirement, but if you're within a couple of years trying to decide, do I do one more year, 2 more years, or now, that could take some of the ambiguity out of it. Or for Kathy, but.
That's okay. We can do that. Questions, any other questions around that? The next item on the agenda is elections. We have an advisory committee that represents you as a retiree or as an active member. Currently, we have 3 individuals for retirees and 3 individuals for actives. Our actives right now are Krista Sullivan, over there, Jessica and Blake. Jessica's term is expiring at the end of this year.
Yeah.
However, information was sent out and asked for nominations for anyone in the actives that were interested in running. I received none. Jessica has volunteered to run and serve again. So rather than go through the whole formal ballot thing, for those actives who are here, is everyone in favor of Jessica serving and representing you?
Yes.
Is anyone opposed? Congratulations. Yeah. That was a hard campaign.
Final term.
That was a hard campaign and tough campaign you ran.
I am tired.
Now, the retirees, we have a little bit different situation. We have 3 retirees that serve. We have Lola Mann, whose term is expiring this year. We have Barb Mitchell, whose term is up next year. And we have Rich Bright, whose term was up the following year. Rich passed away last week. And Barb has expressed that she does not wish to continue on the committee. She's got some other things that she'd like to do and has served for 10 years and would like to pass that duty on to someone else. So we've had 2 individuals who have expressed interest in running, and Lola has expressed that she would, while her term is expiring, she would continue to serve, but perhaps not her full 3-year term. Preferably not.
Temporary.
Temporary was the word she used.
Younger blood to mine.
So we had 2 individuals step up and express interest. Jan Stribling, 1. And Scott McClellan is the other. Who would be interested in serving from a retiree perspective? Chris, would you be interested? Yeah. So Lola,
Yes.
are you okay with
Oh, I can
giving?
live with that.
Yeah. You like pushing back.
He's younger than
So we have those 3 individuals. Is there anyone here, anybody else who would like to serve? Again, we reached out to retirees and received 0 nominations prior to today. So I thank the 3 of you. And if there's anyone here that's opposed to that, speak now. Or you 3 are welcomed onto the committees. Yay. Lola, how many years have you served?
Not the same as Barb, I think, maybe.
So Barb and Lola.
Same time, maybe a year longer.
Barb and Lola, who have 10+ years of experience, thank you for all of your. With that, I don't have anything further on my agenda. If you're interested, Brad can go through some of this excess earnings information for you. Feel free to stay for that portion. Brad.
Like that, have not been receiving emails from, from me, if you would like to give you, I'll tag them.
All right.
For those that were elected, your names will go to the board for. Very much.